Dividends aren't just payments, they're your ticket to building a portfolio that rewards you every quarter, month after month. Today, I'm breaking down 7 high-performing dividend stocks and funds I personally own, showing you the numbers, the strategy, and exactly why these picks can generate steady income even when the market feels unpredictable. If you want your investments to start working for you, this is the roadmap you can't afford to miss. There are countless dividend-paying stocks out there, yet not all of them are created equal. Some companies distribute a small token dividend while others offer substantial and steadily growing payouts that can significantly contribute to your income over time. Dividend investing is a strategy favored by both beginners and seasoned investors, and when executed correctly, it can provide a steady stream of income while also potentially appreciating in value. In this video, we're going to delve deep into 4 top dividend-paying stocks that I personally hold in my portfolio, analyzing not only their dividend yields but also the underlying business fundamentals, historical performance, and growth prospects. By understanding these factors, you can make more informed decisions about which stocks to include in your own dividend portfolio. Let's start with a quick refresher on dividends. Dividends are essentially discretionary distributions of a company's profits paid to shareholders. When a company earns revenue, it incurs costs, and whatever remains as net profit can be reinvested into the business to fuel growth, used to acquire other companies, or returned to shareholders in the form of dividends. Not all companies pay dividends. Some prioritize reinvesting profits to accelerate expansion. However, companies that choose to reward shareholders through dividends demonstrate a commitment to sharing the fruits of their success, providing an additional layer of return beyond stock price appreciation. A well-constructed dividend portfolio can offer consistent payouts, which is especially valuable in uncertain market conditions. High-quality dividend-paying companies are often mature, stable, and resilient businesses. They tend to have strong cash flows, robust balance sheets, and a long history of generating consistent earnings. This makes dividend income relatively predictable and can create a sense of financial security for investors relying on these payments to support their lifestyle or to reinvest for long-term wealth building. The first stock we'll examine is Home Depot, ticker symbol HD. Home Depot is a household name in the United States, known for its extensive network of home improvement stores and its dominance in the industry. Over the past 5 years, Home Depot has delivered an impressive total return of approximately 88% to investors. Its stock price has shown fluctuations, reaching lows around $270 in mid-2025 and highs surpassing $330 in August and late 2025, reflecting seasonal and economic factors that impact the home improvement sector. Home Depot currently offers a dividend yield of 2.67%, which is above the sector average for retail and home improvement companies. For each share owned, investors receive roughly $2.90 per quarter. The payout ratio is 46.68%, indicating that less than half of the company's net profits are allocated to dividends, leaving ample room for reinvestment and growth. A payout ratio below 50% is generally considered healthy, signaling that the company is not overextending itself to fund dividends. Furthermore, Home Depot has demonstrated 14 consecutive years of dividend growth, which underscores its commitment to returning value to shareholders consistently. The company's financial strength is also evident in its market capitalization of approximately $200 billion, as well as a 5-year expected PEG ratio of 1.7. Analysts rate Home Depot as a strong buy, with an average target price of around $327, significantly higher than its current trading price of approximately $291. Home Depot's competitive edge comes from its dominant market share and its ability to cater to professional contractors in addition to general consumers. While Lowe's is its primary competitor, Home Depot maintains higher profitability, better operating margins, and a more favorable outlook for sales in 2026, reflecting its operational efficiency and strategic positioning. Next, let's turn to Procter & Gamble, ticker symbol PG. Procter & Gamble is a global consumer goods giant, producing well-known brands across household cleaning, personal care, and health products. As of early 2026, PG is trading around $150 per share, with a dividend yield of 2.42%. Shareholders receive approximately 0.91 per quarter for each share held. Although the payout ratio is slightly higher at 64%, it remains within a manageable range, suggesting a balance between rewarding shareholders and investing in ongoing business operations. Procter & Gamble has a market capitalization of about $360 billion, reflecting its size and stability as a multinational corporation. The company has consistently generated robust operating margins, with 21.61% in the most recent fiscal year, significantly outperforming peers such as Kimberly-Clark. In fiscal 2025, P&G produced $14 billion in net revenue, a notable increase from $12 billion in 2022, demonstrating a steady organic growth trajectory. Price increases of approximately 10% last year helped offset declines in sales volume, showcasing the company's pricing power and brand strength. For investors, P&G represents a low-risk dividend stock with stable long-term prospects. The 2026 growth forecast for the company is around 4 to 5%, reflecting steady but not explosive expansion. While the dividend yield may not be extraordinary, it supplements the stock's potential for price appreciation, offering a reliable component of total return. The company's diversified portfolio of essential consumer products provides resilience in fluctuating economic conditions, making it an attractive holding for long-term investors seeking both security and incremental income. Our third stock is Altria, ticker symbol MO. Altria operates primarily in the tobacco sector, with a strong presence in traditional cigarettes as well as smokeless products and e-cigarettes. Despite the declining popularity of smoking, Altria has maintained an exceptionally high dividend yield of 8.35% in early 2026, reflecting the company's commitment to shareholder payouts. Investors receive approximately 0.94 per share per quarter, making it one of the highest-yielding dividend stocks in the market. However, the payout ratio stands at 76.78%, which is considerably higher than Home Depot or P&G, indicating that the company allocates a large portion of its profits to dividends. This higher payout ratio comes with additional risk, as it may limit the company's ability to reinvest aggressively in growth initiatives. Altria's stock price has experienced volatility, dropping from around $55 to the mid-40s in the past year. Despite this, the company is strategically navigating the transition to reduced-risk products such as e-cigarettes, including its acquisitions in the vaping space like Juul. Analysts currently rate Altria as a hold, with an average price target near $49.63, suggesting moderate upside potential. While Altria carries some risk due to regulatory pressures and declining cigarette consumption, its substantial cash reserves and commitment to dividend payments make it appealing for income-focused investors willing to accept moderate volatility. Finally, let's examine Bank of America, ticker BAC, one of the largest banking institutions in the United States. BAC serves over 60 million customers and a wide range of small and medium-sized businesses. Given recent disruptions in the banking sector, some investors have been hesitant to hold bank stocks. However, Bank of America has demonstrated resilience, and its stock currently trades around $27.94 per share. The dividend yield is a healthy 3.1%, providing approximately $0.22 per share per quarter, and the payout ratio is an exceptionally conservative 27.15%, indicating that the bank retains a significant portion of earnings for operational and strategic initiatives. Bank of America's stock has seen fluctuations over the past year, dropping from nearly $40 to the high 20s, largely influenced by market sentiment rather than fundamental weakness. Analysts rate back between a buy and a hold, with an average target price of $37, highlighting potential upside. Historically, BAC has maintained strong liquidity, capitalization, and a diversified business model spanning consumer banking, wealth management, and investment banking. These factors, combined with a solid dividend, make it a long-term holding suitable for investors seeking stability in the financial sector. Investing in these four companies, Home Depot, Procter & Gamble, Altria, and Bank of America, illustrates the diversity within dividend investing. You have exposure to consumer discretionary goods, essential household products, high-yield but more cyclical tobacco, and financial services. This mixture balances growth potential with income stability and offers a practical approach for building a resilient dividend portfolio. Each company brings unique strengths and risks, and understanding their individual metrics, historical performance, and market positioning is crucial to making informed investment decisions. Continuing from the previous discussion, let's explore the next set of high-quality dividend-paying investments that can strengthen a well-rounded portfolio. The stocks and funds we'll cover in this segment span the consumer staples, exchange-traded funds, ETFs, and real estate investment sectors, offering a combination of stability income, and growth potential. Starting with PepsiCo, ticker PEP, this global food and beverage giant is a prime example of a dividend-paying company that combines resilience with a diversified product portfolio. As of early 2026, PepsiCo trades near $183 per share and offers a dividend yield of 2.51%, which translates to approximately $1.15 per share quarterly. Its payout ratio is 67.69%, slightly higher than some other blue-chip dividend payers, but the company's strong cash flow and history of reliable dividend growth mitigate the associated risk. What sets PepsiCo apart from many other dividend stocks is its diversified brand ecosystem. Beyond its namesake soda, PepsiCo owns Frito-Lay, Quaker Oats, Gatorade, Doritos, Cheetos, and 7-Up, among numerous other global brands. This diversity enables PepsiCo to navigate market fluctuations more effectively. For example, during periods when beverage sales are stagnant or soft, snack sales often compensate, maintaining overall revenue stability. This diversification also supports steady dividend payments, which have increased consistently over decades. In addition, PepsiCo has shown the ability to adapt to economic pressures. Supply chain challenges, rising labor costs, and inflationary pressures in recent years impacted margins. Yet, PepsiCo has implemented strategic pricing adjustments and efficiency improvements that preserved earnings growth. For instance, in 2025, the company announced a $260 million partnership with 3 major farmer-facing organizations, designed to support more than 3 million acres of U.S. farmland. This not only strengthens its supply chain resilience, but also reflects a long-term commitment to sustainable operations, a factor that further secures its ability to continue dividend payouts reliably. Analysts currently rate PepsiCo as a buy to hold, with a price target around $191, reflecting modest upside alongside its dependable dividend income. Next, we move to a slightly different approach with the Schwab U.S. Dividend Equity ETF, ticker SCHD. Unlike individual stocks, SCHD provides broad exposure to a diversified basket of dividend-paying U.S. companies. Trading near $73.23, it offers a dividend yield of 3.61% and a price-to-earnings ratio of 13.89, making it an attractive option for long-term dividend-focused investors seeking simplicity and risk mitigation. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which focuses on high-quality companies with consistent dividend histories. Its top sectors include consumer cyclical, financial services, healthcare, industrials, and technology, reflecting a balanced and diversified portfolio. Notably, some of its largest holdings are well-known names like Home Depot and PepsiCo, meaning investors effectively gain access to multiple blue-chip dividend payers with a single investment. An additional advantage of SCHD is its extremely low expense ratio of 0.06%, making it a cost-efficient way to maintain long-term exposure to dividend equities. ETFs like SCHD are particularly useful for investors who want to mitigate single-stock risk while still enjoying reliable income streams. By dollar-cost averaging into such funds, investors can steadily accumulate shares, benefit from compounding dividends, and participate in broad market growth without actively managing individual stocks. Finally, let's discuss Realty Income Corporation, ticker O, a real estate investment trust, REIT, famously known as the monthly dividend company. Realty Income currently trades near $60.65, with a dividend yield of 4.75%, making it one of the higher-yielding options among blue-chip dividend investments. Unlike most stocks that pay quarterly dividends, Realty Income pays monthly, providing predictable and frequent cash flow, an attractive feature for income-focused investors such as retirees or those seeking supplemental income. Realty Income's portfolio includes over 12,000 properties with long-term lease agreements that provide consistent rental income. The company has been operating for more than 50 years and has declared 633 consecutive monthly dividends, demonstrating remarkable stability even through multiple economic cycles, including recessions and periods of rising interest rates. While the payout ratio occasionally exceeds 100% on an accounting basis, this is common for REITs, as they are structured to pass a significant portion of cash flow directly to shareholders. Analysts rate Realty Income as a buy to hold, with a price target near $70. Suggesting potential capital appreciation in addition to reliable monthly dividends. Realty income also serves as a hedge against market volatility. While equities can fluctuate based on earnings reports, macroeconomic factors, and investor sentiment, rental income from commercial real estate is relatively stable, especially when leases are long-term and tenants are financially secure. This makes REITs like realty income an excellent diversification tool within a dividend-focused portfolio. Moreover, exposure to real estate provides inflation protection because rental rates often adjust upward with inflation, preserving the purchasing power of dividend income. Now, having covered PepsiCo, SCHD, and realty income, it's important to take a step back and understand the broader principles that emerge from these investments. First, sustainable dividends are far more important than the absolute yield. A sky-high dividend might appear attractive, but it could signal underlying financial stress or an unsustainable payout. Companies with moderate but consistent dividend growth, such as PepsiCo or realty income, often present a lower risk option for long-term investors. Second, diversification across sectors and investment vehicles is essential. By combining consumer staples, financials, ETFs, and REITs, investors reduce exposure to sector-specific downturns while capturing income from multiple sources. Each of these investments has different cash flow drivers, risk factors, and growth potential, creating a more resilient portfolio. For instance, consumer staples like PepsiCo are resistant to economic downturns, whereas ETFs like SCHD provide broad market exposure, and realty income offers real estate-derived income that can behave differently from equities. Third, history and operational resilience matter. Companies with long track records of dividend payments like Procter & Gamble, Home Depot, and Realty Income demonstrate a consistent ability to generate free cash flow and maintain shareholder rewards. This history is a critical indicator of future reliability. Dividend growth, not just yield, signals that a company is healthy, generating profits, and confident in its future cash flows. Fourth, dividend investing requires thoughtful evaluation beyond surface metrics. It's important to assess payout ratios, cash flow sustainability, debt levels, market positioning, and regulatory exposure. For example, Altria's high yield is tempting, but investors need to consider regulatory challenges, declining cigarette consumption, and industry shifts towards smokeless products. Bank of America offers moderate dividends with a conservative payout ratio, but it is influenced by interest rates and regulatory oversight. Understanding these nuances ensures a balanced and risk-aware approach. Finally, dividend investing is not a passive strategy in the sense that you blindly chase yield. It requires due diligence, ongoing monitoring, and strategic allocation based on individual goals and risk tolerance. The goal is to construct a portfolio that provides reliable income while balancing growth, sector diversification, and risk management. By integrating these 7 dividend-paying investments, Home Depot, Procter & Gamble, Altria, Bank of America, PepsiCo, SCHD, and Realty Income, investors can achieve a combination of stability, cash flow, and growth potential. Each component adds unique strengths. Home Depot provides sector dominance in retail, P&G ensures resilience in essential goods, Altria adds high yield but cyclical exposure, Bank of America strengthens financials, PepsiCo offers consumer staples diversification, SCHD delivers broad dividend exposure, and Realty Income provides real estate income and monthly cash flow. This approach creates multiple income streams, mitigates risk, and positions investors to navigate both volatile and stable markets. Dividend investing is a long-term strategy. The compounding effect of reinvested dividends can significantly enhance total returns over time, potentially surpassing the growth of non-dividend-paying stocks in the long run. By maintaining discipline, evaluating fundamentals, and prioritizing sustainable dividends, investors can build a portfolio that generates consistent, predictable income while participating in capital appreciation. In conclusion, dividend stocks and funds represent a compelling avenue for investors seeking stability, income, and long-term growth. While each stock carries its own risk profile and market dynamics, combining them strategically can produce a diversified and resilient portfolio. Whether you are just starting your investment journey or seeking to augment existing income, the principles demonstrated by these 7 holdings, consistent cash flow, operational strength, historical reliability, and diversification, provide a roadmap for constructing a successful dividend-focused investment strategy. Always remember that these examples are based on personal experience, research, and publicly available data. They are not formal financial advice, and it's essential to perform your own due diligence, understand your risk tolerance, and align investments with your personal financial objectives. When approached thoughtfully, dividends can serve as both a reliable income stream and a cornerstone of long-term wealth creation, allowing investors to participate in the growth of successful companies while benefiting from recurring payouts. 7 of the top dividend-paying stocks and funds that provide consistent income while still offering long-term growth potential. It starts by explaining what dividends are, a portion of company profits paid to shareholders, and why building a dividend-focused portfolio can give investors predictable cash flow, especially during volatile market periods. The script emphasizes the importance of analyzing not just dividend yields, but also payout ratios, company stability, growth prospects, and market positioning. The first stock featured is Home Depot, HD, highlighted for its dominance in the home improvement sector, consistent dividend growth over 14 years, and strong 5-year returns of 88%. Its payout ratio and dividend yield are examined alongside competitive advantages over Lowe's, such as catering to professional contractors and maintaining higher operating margins. The script notes that dividend payments are only part of the appeal. Long-term company fundamentals matter to ensure total returns remain positive. Next, Procter & Gamble, PG, is explored. The script outlines its steady 2.42% dividend yield, healthy operating margins, and strong market position in consumer goods, comparing it favorably to competitors like Kimberly-Clark. It highlights PG's ability to grow revenues organically, adjust pricing effectively, and maintain a stable dividend even in challenging economic conditions. This segment stresses that PG is not a high-risk, high-return play, but a reliable long-term dividend stock. The script then shifts to Altria, MO, a higher-risk, higher-yield dividend stock at 8.35%. It explains the challenges facing tobacco companies, including declining smoking rates, while also covering Altria's strategic pivot toward smokeless products and e-cigarettes. Despite the sector risks, Altria's strong cash reserves, dividend history, and relative undervaluation make it a compelling income-focused investment for some portfolios. Bank of America, BAC, is featured next, illustrating how a major banking institution can provide a stable 3.1% dividend yield even amid sector volatility. The script evaluates BAC's payout ratio, historical stability, and analyst perspectives, noting that its size, diversified customer base, and strong liquidity reduce systemic risk. It also discusses regulatory challenges and how they may affect long-term profitability, providing context for investors weighing bank stocks. The second half of the script introduces PepsiCo, PEP, emphasizing its 2.51% dividend yield, diversified product portfolio, and ability to navigate supply chain pressures while maintaining revenue growth. Real-life examples, like partnerships supporting U.S. farmland, illustrate the company's resilience and forward-looking strategy. The script contrasts PepsiCo with competitors like Coca-Cola to justify its selection. The script then covers SCHD, the Schwab U.S. Dividend Equity ETF, highlighting how investors can gain exposure to a diversified basket of high-quality dividend-paying companies in one investment. With a 3.61% dividend yield and low expense ratio, SCHD is positioned as a buy-and-hold option that reduces risk through diversification while still providing consistent income. Finally, the script examines Realty Income Corporation, O, a REIT offering a 4.75% monthly dividend. It explains how Realty Income owns income-producing real estate assets under long-term leases, providing predictable cash flow. The script notes the high payout ratio typical of REITs, addresses investor concerns about interest rates and real estate risk, and emphasizes the company's track record of consistent dividends, making it a strong option for portfolio diversification into real estate. Throughout the script, there's a recurring emphasis on doing your own due diligence, understanding both dividend yield and company fundamentals, and building a balanced, resilient portfolio. The script also includes references to practical tools for finding high-dividend stocks, such as investment apps, and underscores the value of combining stable dividend payers with growth-oriented strategies to generate income while preserving long-term wealth. The overarching takeaway is that dividend-focused investing, when approached strategically, can provide a reliable, growing income stream, reduce portfolio volatility, and reward long-term shareholders, all while allowing investors to benefit from both stock price appreciation and steady payouts.